Hi, everybody. This is Josh Jalinski, the financial quarterback, talking about the rules of the game. Now, you could follow two rule books. You could follow the rules of wealthy people, financial institutions, and the government that want your money. They want it periodically. They want it on a regular basis. And then when you want it, they want to give it to you little by little when you want it back to yourself. But you can also have your own rule book. So you can win the financial football game. We went through the first four rules in the previous show. In this show, we're going to go through rules 5, 6, 7, 8, and 9, which are powerful. Once you've satisfied the rules of saving 15% of your pay, getting 6 months saved in an emergency fund, and then making sure you have that wealth coordination account, then and only then should you max out your 401k. Should you contribute to the 401k? But you don't contribute the max first. You contribute up to the employer match portion first. Now, eventually you max out, but first you want to at least get the employer match. Many 401ks offer an employer match. Something like they give you 3% of your salary or 50% of up to the first 6% of your salary. And you want to contribute no more than half of your gross annual savings rate to the retirement account. Why? This is because your plan should be balanced so that you have adequate protection, adequate liquidity, because you don't have a lot of liquidity in your 401k. So let's say you're coming in a lot of money. I saw a guy the other day, he said, Josh, I'm coming into a $25 million job. Make a lot of money. What do I do? Well, he could max out his retirement plan, but he also needs to have other money for reinvesting in his business, liquidity, diversification to take advantage of opportunities. So that's why we suggest contributing the no more than half of your savings, that 15% saved, to a 401k yet. After you've done all those other things and you have ample liquidity to take advantage of opportunities when that beach house comes for sale, then and only then can you max out. Consider where future tax brackets might be when you retire also. This is why various types of income in retirement make sense. Meaning you want to have multiple streams of income, MSI. So let's say all you have is 20 grand to save in a 401k. And you have sufficient emergency funds. You may want to put 10 in a traditional 401k for the write-off now and 10 in the Roth so that you have tax-free money for build-up later. So this is all about like diversification of strategy. A lot of people talk about, well, I'm going to diversify. My advisor said to diversify. Well, diversification's good, but it doesn't mean you just own a bunch of crap or you just own 500 different stocks. I'm talking about strategic diversification. Okay, I have some Roth, I have some insurance, I have some 401k, I have some emergency fund. You have these different buckets of money for different things and you're coordinating them. Rule number 6 is be a lender. Now, I'm not talking about hard money lending, although you could do that. Once you've completed your full protection, so you've completely protected yourself from calamity, and you have savings component rules and requirements, you are then ready to go into the growth component. These financial assets, and rule 6 is be a lender. Loan money to the government, get a treasury. Loan money to a municipal government, get a municipal bond. Loan money to a corporation, get some interest from that. These financial assets are more income-oriented, more conservative generally. Some even have guarantees, and some have lower risk. Also, you are lending money to the federal government, corporations, and or municipalities. So rule number 6, be a lender. Rule number 7, be an owner. You're never going to be amounting to significant wealth if you're just a lender. We want you to own trophy financial assets, companies, car washes, businesses. Once you have completed your first level of growth, which are more of the lending category, then you move to ownership. That's you're owning companies. Those are called equities. When you buy a stock, you're literally owning equity in a company. These financial assets are income and growth oriented, but more risk than bonds, municipal bonds, corporate bonds, or government bonds. Instead of being a lender of your money, as in the first tier of the growth component, now you're being second tier, you're being an owner, you're a shareholder. You get to participate in the potential profitability of the company and appreciation of their value. Own hard assets. So a lot of advisors too, the reason I love my model, you'll have bond people, you'll have stock people, and they usually don't mix well, and then you'll have hard asset people. I believe in all of them. Why? Let's say you love real estate and you're a hard asset person. Well, you would need liquid assets to buy more real estate, which can be in the growth component, in lending-based assets or equity-based instruments, or in emergency fund type vehicles. Once you have completed your first and second levels, think of it like a video game, be a lender. Second level, be an owner. Third level, own the hard assets. Those growth assets have the greatest opportunity for building wealth, but have the greatest asset. Think owning a business, owning like your own business, a tax shelter, real estate. These financial assets provide opportunities for income and growth while providing tax benefits. Similar to the second tier, you are an owner of these assets and businesses, and you may control these assets, enjoy their use and gain tax benefits, receive income now off the rents, build capital appreciation, and significantly reap many other advantages. Rule number 9, once you've built this, now you got to maintain, balance, and monitor your plan. That's the hardest for a lot of successful people. They just get too busy with this. You'll need to periodically rebalance your model to adjust for the changing circumstances in your life and the economic world around you. This is taken from the LEAP model rulebook. The ongoing use of the model is designed to help you organize your financial life, make each dollar work efficiently, give you peace of mind, increase protection against unknown risk, provide greater income, greater legacy, greater control, and simplify your financial life and decision-making. If you had a third in bonds, a third in equities, and a third in hard assets, you would almost never have a financial ruinous thing. If you think about it, in times of calamity, hard assets and lending-based assets are better than growth assets. Time of growth, hard assets and growth assets perform better typically than lender-based instruments. Now, what about debt? How does debt play a role into your very financial picture? Debt management plays an integral role in your life. Properly structured debt, known as good debt, will allow you to have additional cash flow available for wealth building strategies within your model. One of my regrets in life was I was a big fan of being debt-free, still am, and I respect everyone who is. I didn't take advantage of maybe buying some extra properties with debt that I could have 10 or 12 years ago when rates were low and property values were low. It's a big regret I have. I was a little too conservative. That's okay. I can learn. Now, that being said, what about now when rates are 8%? Well, that may be bad debt. You have to incorporate then into your investment decisions. Maybe you rent a home. Maybe you don't buy. And maybe you just bank money, bank some serious cheddar, as we used to say. Because you never know. Interest rates start to come down again, and then you buy. Too much consumer debt or high interest credit card debt, that's bad debt. We don't want any of that. Will negatively impact your cash flow and limit your wealth building opportunities. Good debt can be characterized by low interest. It's potentially deductible. It's an installment payment plan. Bad debt, high interest, non-deductible. Too much revolving credit. Again, I'm going to give you a rule book summary. Rule number 1, full replacement protection. Max protection. Rule number 2, save 15% of your earned income. Rule number 3, build a liquidity fund of minimum 6 months in the bank. Rule number 4, avoid compounding taxable interest. Rule number 5, contribute to your retirement account. Rule number 6, be a lender. Rule number 7, be an owner. Rule number 8, own hard assets. And rule number 9, maybe you have all those 8 things. Are you monitoring what you're doing? Are you balancing it strategically? Not a rebalance. Notice I didn't say rebalance. I said balancing what you have strategically. And what is the end game of all this? It's literally to get 12 checks in retirement. And the categories are really 8 different streams of income in retirement. Did you know that you can get 8 streams of income in retirement? And for our clients, it could be a normal occurrence. How so? Well, following the rules of a successful plan can help you create an enjoyable retirement by continuing protection strategies throughout retirement, enjoy many kinds of retirement income, not just 1 or 2, and I'll reveal those at the end of the show. 3, reduce fear of running out of money. A lot of people, their biggest worry is running out of money. There are products that solve that. There are strategies that solve that. Number 4, generate income through a pay down strategy. What's a pay down strategy? You don't have to leave $1 million to your kids. Maybe you pay down that account so you have a little more enjoyment, a little bit more fun. So instead of being rigidly applying the 3% rule, the 4% rule, you spend it over a 20-year period. You do a pay down. You do a reverse mortgage so that you have the equity in the house, but you're enjoying the equity. It's not just trapped inside your house. Also, you want to increase access, use, and control over assets and income. And then we want to create income that is more tax efficient and diminishing the impact of law changes, particularly tax law changes and market fluctuation. A lot of people, if they change the tax law, you'd be screwed. So you got to be careful. You understand how the rules work and how to get them back in your favor. And then ultimately, to provide a legacy for you and your family, the people you love and the causes you love. So let's go over how you can position. I want you to write this down. 8 streams of income, 8 multiple streams of income that you could get. 1, government programs. Live off the government, right? Social Security is an example of a government income stream that everybody gets. Number 2, trust income. Number 3, life insurance withdrawals or loans or dividends. Number 4, interest from the bank you could get as a check sent to you, or principal pay downs like we discussed. Then you can get annuities, pensions, and retirement account income, what are also called systematic withdrawals. It was somebody today go, hey, I thought I had to annuitize an annuity to get the income. I said, no, you don't have to annuitize. In fact, you don't want to annuitize because annuitizing means you're annuiciding. You're literally committing suicide on your principal accounts. And when you die, the money goes to no one but the insurance company. But you can have an annuity and take systematic withdrawals or rider income. Also, you can get interest, dividends, and principal paydowns from bonds or equity instruments. You can also get capital gains and income off of real estate and your business. So those are the 9 checks that we can help a listener make. Now, to sum it up, you must strategically position your money now. Rule number 1, full replacement protection. Unforeseen events can happen at any time, and you always want the most protection at the minimal cost. Rule number 2, save at least 15% of your earned income for retirement. Rule number 3, build liquidity. You need to have ready money. Ready money is Aladdin's lamp. Rule number 4, avoiding compounding taxable interest so you don't get socked by the tax man. Rule number 5, contribute to retirement accounts. Once you've satisfied rule 2 through 4, you're in a great position to max out that 401k. Number 6, be a lender. Then number 7, be an owner, own equities. Lender, you own bonds. Rule 7, you're an owner of equities. You own shares of stocks. Rule number 8, own hard assets. Rule number 9, maintain and balance your portfolio regularly, at least annually, to maintain the optimal model. Those are the 9 rules of wealth that you need to know about right now.